time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. Called Mogo Inc., symbol MOGO on the TSX. We've interviewed this management team. They're actually from Vancouver. We ended up talking to them in California at an event. The stock price is 82 cents. Stock is down 77% over the past year and over 94% since its 2021 highs. Market cap is just under 62 million. There's no dividend here. The company, I'm going to describe it. They're a fintech company. They state they have 2 million members, which they assist with simple digital solutions to get control of their financial health. They have a free app, the Mogo app. Consumers can access a digital spending account, get free monthly credit score monitoring, and ID fraud protection, as well as personal loans and mortgages. The company also owns Mogo Trade, and that app offers commission-free stock trading, and together with Mogo, their wholly owned subsidiary, brings automated, fully managed flat fee investing to Canadians. Well, let's look at the good here in terms of the recent financial results. Revenue was up 12% year over year. Members were up 17% year over year. Adjusted OPEX or operating expenses were down 24%, and adjusted EBITDA was up 32%. So the member growth here, if you look back to Q1 of the year, or Q3, sorry, of last year, it was about 1.77 million. It's at 2.21 million as at Q3. So year over year, significant growth there. There's cost savings. An initiative was put forward to restructure, and cost savings initiatives have been going forward with this business. They drove improvement in OPEX. OPEX was down 24%. And adjusted EBITDA, again, improved 32%. The okay here, after the bad, is the balance sheet. As at September 30th, in their presentation, Mogo states that they hold 106 million in cash, investments, and digital assets. On the balance sheet, we see 35 million in cash. That is down from 69 million at the start of 2021. So that's quite a decline. And under investment accounted for using the equity method, we see 56.13 million. That's down from 103.82 million at the start of 2021. This is basically the company's strategic investment in CoinSquare, one of Canada's leading digital asset trading platforms. We've seen trading volumes are down significantly even since September, and I will guess here that there'll be another write down in the value of this investment coming soon. The company also has 47.7 million under a credit facility and 39.69 million in debentures. The credit facility is at a variable rate and now substantially higher rate than at the start of the year, last year. It's subject to certain covenants and events of default. So as at September 30th, I'll make it clear, 2022, the company was in compliance with these covenants. But if asset values on the balance sheet continue to drop and cash flow is negative, it is something to watch. Not in trouble as of the last report, but something to watch here. The bad here. Well, we said adjusted EBITDA was up, but it is still negative for the last quarter. Negative 2.8 million in adjusted EBITDA. And the adjusted net loss was 8.4 million. As at the end of Q3, Mogo has an accumulated deficit of 239 million. So our take here, startups are great, and new tech and growing a user base takes a great deal of time. But at some point, a company has to start generating cash flow and operate off of that cash flow. Mogo is not a terrible venture. In fact, it is admirable the company has been able to generate 2 million members. But those members need to be monetized into a profitable model. Otherwise, for shareholders, what is the point of the venture? Mogo currently has its restructuring plan. It's focused on accelerating the company's path towards profitability. This is good, but with this plan comes an expected 10 to 15% impact on quarterly revenue in the near term due to cost cutting, essentially. So without the constant spending, growth suffers. The question is, was the company just buying growth in an easy money market with a business model that is not that profitable, if at all? The market is clearly stating they're skeptical. There is likely some value here in the customer base and the tech, and perhaps Mogo is purchased on the cheap at some point, but we do not invest based on that criteria. We will monitor Mogo's restructuring to profitability progress, but prefer to invest in cash flowing growth businesses at reasonable prices versus cash flow negative business with the hope of future profitability. Just too much risk and not enough upside. We find more upside in the businesses with the other profile.
Yep.
So anybody want to discuss that?
Well, we followed Mogo more closely a couple of years ago. We actually met with the CEO when we were at a conference in Los Angeles. And
Yeah,
I believe that they, at least on an adjusted basis, at one point, it looked like they were becoming profitable. They're starting to look a little more interesting. One thing that I didn't like about the business is that they were a bit of a hybrid company. They had the fintech side, and they had a side that was just more traditional finance where they had a loans portfolio. So it was, not totally simple to separate the two. I figured, either you're a fintech company or you're a loans company, basically. But we followed it in the past. It had gotten profitable for a couple quarters, at least on an adjusted basis. The stock performed well, but it's like Warren Buffett says, when everybody floats when the tide's in, it's when the tide goes out, you see who's
naked, swimming naked,
I guess. And that was probably the case here. Now, a lot of that capital has been sucked out of the tech space, out of the fintech space, and companies actually have to have real business models that are producing earnings and cash flow. So, in terms of value it, getting on the cheap, I don't know how you value it if it's not profitable.
Yeah, it's very difficult. And I know they've been running down their loan book, so it's not always light comparisons. But if we look like back to 2018, they had 26.9 million. Then 2019 went to 34.5 million in revenues. Then 2020, 25 million. Then 2021, 23, now trailing at 26.7. There's actually not a ton of growth there. Now, there may be growth in the fintech outside of the loan side, but it's still a relatively small revenue base. The valuations it achieved when the stock was in the $11 range were insane. Again, companies that grew up during that free money segment really, just didn't have a focus on a bottom line because you didn't need one. You could raise money so easily in the market. And now the whole culture of this company and many businesses that were doing this, I think I've talked about this in the past, has to change. It's one thing to be a company that you don't really have to focus on cash flow in the bottom line because you can get money so simply in the market. Now money costs more and nobody wants to give money to these companies. So they have to suddenly become a company that is minding the bottom line. How will employees like that, when their stock options aren't doing as well? How will, how does the culture
they just
of that
need to be managed more, right? Like if money is easily accessible, you don't have to manage the margin. I mean, that's a completely different corporate culture, working culture.
And everybody gets to spend when they're on the road,
counting the paper clips, right? Yeah, exactly. And then you don't have your office parties. It's a totally different corporate culture.
And the question is, were they just buying growth? Because now that they're pulling back, CapEx spending isn't there. Do we see no growth? Do we start to see negative growth in the business? And, that's something to monitor. Again, having 2 million users is something admirable. Maybe if somebody finds that as a base they want to get their hands on, maybe one of the banks wants to buy it, but they're building their own apps as well. So, or have built in some cases. So we'll see where it goes with Mogo. But right now, there's just great businesses out there that we can find that are actually producing cash flow and growing that just have a lesser risk profile and similar upside. So I'm not sure why we would put our money towards this until they can say we can grow out of cash flow, and we can grow per share earnings. And we don't see that right now with Mogo. So we would just sit on the sidelines and monitor till they get there. Or if they don't get there, it's never going to be an investment for us.